Well, joining me now is Sheila Blair, the former chair of the FDIC, which had to take control of Silicon Valley Bank on Friday, and Steve Liesman is CNBC's senior economics reporter. Welcome to both of you. Steve, let me just start with you. What's going to happen tomorrow morning?
Well, we're waiting to hear what regulators say, what the Federal Reserve says. Do they do anything to try to calm market either through a statement or any kind of programs? We don't know that if that's the case at this point. It's a big question tomorrow morning, Chuck. Two things. One is, does the FDIC announce how much uninsured depositors will get? And that number could be fairly critical, Chuck, as to the kind of confidence that would permeate through the market. If the number is something like 80 cents or 90 cents on the dollar, there might be some calm that would pervade the markets. If it's 50 cents on the dollar, then I think uninsured depositors at other banks are going to be concerned. That's one. The second thing is, does the Federal Reserve work with other agencies to provide anything regarding insurance or some kind of assistance to those who are sitting on uninsured deposits at other banks?
All right, Sheila Blair, you ran the FDIC. What can we expect from them tomorrow morning?
So I think you can expect what the advanced dividend will be on the uninsured. And I want to emphasize that might not be the total recovery on uninsured. That'll be a number that they feel confident they'll be able to recover.
Will they do it as a percentage?
They do it as a percentage.
Just what he was saying?
Yes, exactly. Okay. So with IndyMac Bank, which is the closest parallel of a failure during the Great Financial Crisis, we announced a 50% dividend. IndyMac Bank was in a lot worse shape than this bank, so I can only assume it's going to be significantly higher.
The fact that they haven't found a buyer yet, is that what your successor is doing right now?
Well, I think so. I hope so. I mean, that's the smoothest way to handle these. And almost all of our bank failures during the Great Financial Crisis, we had about 400 of them. We did purchase an assumption. We sold a failed bank to a healthy bank. And usually the healthy acquirer would also cover the uninsured because they wanted the franchise value of those large depositors. So optimally, that's the best outcome. The problem is this was a liquidity failure. It was a bank run. So they didn't have time to prepare to market the bank because they're having to do that now and playing catch up.
The fact that it was a bank run, Steve, and in fact, it was venture capitalist Peter Thiel's name, who became sort of famous in political circles for getting heavily involved in the 2022 elections. It seemed like he pulled his money out and said, hey, guys, something doesn't look good here. And it started a run. Does that tell you that maybe this is something that can be isolated? Or could this happen at other banks?
Chuck, you're asking the question that Wall Street has, I think, 24/7 been debating since this happened. Let's put the context here. This is probably the first bank run in the digital age. I don't know if Sheila would confirm that. So that means a tweet can cause a bank run. I don't know that we've had a tweet cause a bank run before, but it's worth remarking that comments by people like Peter Thiel and others caused a massive withdrawal of deposits. So there's four things that are thought to make this bank unique. It had a particular risk on in its balance sheet when it came to interest rates. It did not seem to move to hedge that risk. Second, it was highly concentrated in the industry so that all of most of its depositors and borrowers, by the way, were from the same place. Third, it had a lot of losses on its books, which, by the way, a bunch of banks do, but they're unrealized. And the fourth thing was these uninsured deposits. 87%, we're told, of its deposits were uninsured compared to other banks its size that were around 40%. So it's isolated, Chuck. But the key thing for tomorrow morning is, what do regulators do to give people comfort that indeed it was isolated and will remain isolated?
I want to put up, Sheila, here the number of companies that people might be familiar with who had deposits in here, who are all need to make some basic payroll runs here. Does the FDIC, can they sort of help ease the payroll issue on their own, or are they going to need like an act of Congress or something?
Well, no, I think so. They only insure deposits. That's what they do. Right. They charge premiums for the insured under $250,000. They don't insure uninsured. If there's a systemic risk exception, which suggests there's something very wrong, then that's an extraordinary procedure. They arguably could. But I think it's, this is a $200 billion bank, a $23 trillion thing industry, $200 billion bank. I think it's going to be hard to say that this is systemic in any way. For the payroll, I think the advanced dividend will help these companies make that. I know some of the names that you put up there, that's not necessarily payroll. I know Circle, those are reserves behind their stable coin. That's not their money.
Right.
They can't use that for payroll. So I think you need to differentiate.
No doubt.
Yeah.
But these were all the companies that have
These
some...
are companies that had substantial uninsured deposits. That's exactly right.
Steve, you spend a lot of time watching Jay Powell at the Fed. Who should be watching out for these banks as they try to deal with the interest rate hikes here? Is it the Fed's responsibility to warn banks that they need to be smarter about managing the interest rate hikes? Or is this on the banks, and was this on Silicon Valley Bank, who was just sort of perhaps not realizing that, hey, these interest rate hikes might be here to stay?
So, again, a question that a lot of folks are going to be asking tomorrow morning, Chuck. Let me just walk through a little bit of that. Yes, this bank was regulated by the Federal Reserve. Were there enough red flags out there? Certainly some of the postmortems that I'm reading suggest that regulators should have seen this problem in this bank. On the other hand, Chuck, this is still a free market system. Despite massive bank regulation that's out there, banks are free to fail. When you have a change in interest rates like we've had over the past several months, the most aggressive rate hike cycle in 2 generations, some banks' business models are not going to work anymore. Whether or not this bank should have taken steps, I think it should have. It was up to the bank in the first instance, but it's also up to the regulators in the second instance. And that postmortem is going to look at whether or not the regulators should have seen this coming. And the next thing you're going to ask about is whether or not the Fed ought to be cutting interest rates. Certainly, the market thinks that the Fed will be less aggressive now.
I was just going to say, maybe not cut, but
possible fallout.
Yeah, slow down the rate of increase, give banks more time to handle it? Yeah.
That's what people are thinking. That's certainly the way the market dramatically repriced on Thursday and Friday, Chuck.
Assuming that. All right. Sheila Blair, Steve Liesman, thank you both. Sheila, I think a lot of people are going to be tapping into your expertise this week, unfortunately, I guess. But thank you for coming on.
Thank you.
It's great to see you.
Great.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.